Amanda, you good to go now?
Yeah.
Okay. Good afternoon, everybody. This is Paul Matini at Barley Snyder. This session was originally what we call a Barley University, which is our version of a lunch and learn. We understood there was a fair level of interest outside the firm, so we opened it up to clients and friends of the firm. And I'm going to co-present today with my colleague Amanda Kowalski, and she's going to actually do most of the talking, which is great. And also want to recognize our colleague Kim Decker, who can't be here today, but has obviously participated and contributed here. If you have questions, we'd like you to use the chat room because we have a lot of people on here, up to 92, I guess, right now. So that might be the best. Amanda and I are going to try to keep this fairly informal and have some back and forth between us. So the topic is the banking situation, and specifically, obviously, the Silicon Valley Bank situation. Not to minimize the situation, but it does remind me a little bit of, for football fans, when Aaron Rodgers said a few seasons ago, is just relax, RELAX. There was a unique set of circumstances for the most part that caused the issues with the three banks we're going to mention. But that doesn't mean that we can't still learn things from what happened and how things were handled. And we're going to try to point that out. But in going through preparing for this, one quote got my attention. It basically said traditional regional banks and community banks are going to be fine, which I definitely agree with. We have the disclaimer up there, which we have to put on as a law firm, that we're not giving legal advice. So obviously, if you have some follow-up questions, feel free to call Amanda or myself. And people that know me would then take my advice anyway, so that's fine. And then we have biographies for myself and Amanda, just so you kind of know our background. And I've been doing this a long time. And Amanda, pretty much has been working in the banking sector for her entire career. So, and unfortunately, in my background, I have a lot of experience with failed banks, mostly buying failed banks back in the day, but I have represented banks that failed, and I can explain how that usually works and differentiate how things happened in this case. With that, I'm going to introduce Amanda, and she's going to kind of talk about what we're going to try to cover today and give an overview of the situation. So with that, Amanda, go ahead.
Great. Thank you, Paul. And thank you to everyone for joining us today. We're all here, as Paul said, because of a series of events that have happened over the course of about the last 2 weeks. And we're going to discuss all of those events in detail today. But before we get started, I'd like to zero in on a single 4-hour window during that first week. And that's the morning of Friday, March 10th. Friday, March 10th, 8 a.m., Silicon Valley Bank opened for business. It was not exactly business as usual for reasons that we'll discuss today, but all 17 branches opened, employees showed up for work or logged on remotely for work, and customers showed up to transact business. Less than 4 hours later, shortly before noon, it all came to a sudden stop. The bank had failed, it had ceased to exist as a legal entity and was completely shut down. It is really remarkable, and as Paul said, we've been doing this for a while. It's remarkable that a bank that is 40 years old, was seemingly healthy before this time period, had about $200 billion in assets and about $175 billion in deposits, that it could fail so quickly. And that is one of a few unusual things about this bank failure. In addition to the pace of the failure, the fact that there was no buyer for the bank, the factors that caused the bank's failure, the market reaction, and the response by federal regulators. And we'll talk about all those things today. But there were also aspects of this failure that were not that unusual. And Paul and I will kind of distinguish between the two today and hopefully give you some background and give you some perspective that might help you really understand what's going on and sift through some of the noise that you've been hearing. There's been a lot of panic and a lot of news surrounding the events of the last couple weeks. So we hope that we can kind of be a voice of reason today and help you fully understand what's going on. So just as businesses go bankrupt, some banks fail. It is just the end of the life cycle for some banks, and that is how our bank regulatory system is set up. That being said, bank failures are still extremely rare. Out of about 4,700 FDIC insured banks, there have only been 8 bank failures in the last 5 years. So that's something to keep in mind, that as people get hyped up and panicked about what's going on, just want to keep in mind that bank failures still are extremely rare. So we'll start with the timeline of events. On Wednesday, March 8th, Silicon Valley Bank, or SVB, announces a $1.8 billion loss, as well as a planned $2 billion capital raise. That same day, a bank called Silvergate Capital announced that it had suffered major losses and had decided to voluntarily wind up and liquidate its bank. Those two announcements together resulted in SVB stock falling significantly Saturday night. Shares fell about 60%. Thursday, March 9th, SVB stock continues to fall on the basis of the Wednesday announcement. And at the same time, its depositors start to rush to withdraw their deposits. We now know that part of that was because venture capital firms and investment firms in Silicon Valley, a relatively close-knit community, began telling their portfolio companies to pull their deposits out of SVB on the basis of the losses it had announced on Wednesday. Thursday, CEO Greg Becker famously said on an investor call that SVB had ample liquidity with one exception, and that was if people started telling each other that the bank was in trouble, then that would be a challenge. Turns out he was right. By close of business Thursday, SVB depositors had initiated $42 billion in deposit withdrawals. That makes it the largest bank run in history. Why? A huge percentage of SVB's deposits were uninsured. I think the number's around 94%. And we'll discuss FDIC deposit insurance later. But for reference, most large banks have closer to about 50% uninsured deposits. And in the event of a failure, the fate of those deposits kind of hangs in limbo and it's up in the air. Depositors won't necessarily get that money back.
And Amanda, even though it was what they call a classic bank run, right? It really wasn't, because we had the impact of technology. I don't know if you want to mention that, because it's not like people stood out on the street, right? Backing up to a branch. So.
Right. It's easy to initiate a deposit withdrawal. People are monitoring events in real time. They're monitoring what's going on in the markets, what news is coming out. And it really was just fuel to the fire that was already going. There was just a ton of panic. And you could imagine if you were a company with $500 million in deposits at a bank that you caught wind might be going under and might be failing, of course you would rush to pull your deposits out. They were doing what's natural in that case. So Friday, March 10th, as I've already said, around midday, SVB was closed. The regulators entered the bank, physically shut it down. The FDIC was appointed receiver, and the Deposit Insurance National Bank of Santa Clara, otherwise known as the DINB, was created to hold the deposits of the failed bank. Of course, the markets react. Investors start dumping bank stocks and people are panicking again. Typically, the FDIC has a buyer waiting by the time a bank fails. In this case, there was no buyer, and Paul will discuss that a little bit later. But that added to the panic because it was just another level of uncertainty surrounding the failure.
Amanda, the other panic element really was the initial indication from the regulators is they were only going to cover the insured part of the deposits, right?
Yeah, that's right. And I'll discuss that a little bit more.
Yeah, right.
In a bullet or two. But Saturday, March 11th, again, a lot of panic. You can't open the news without seeing SVB has failed. What's going to happen to deposits? The failure is all over the news, and there's a lot of questions, a lot of uncertainty surrounding the failure. Sunday, March 12th, it is announced that Signature Bank out of New York has failed. And a bridge bank, again, has been created because the failure happened relatively rapidly. There was no buyer waiting. So there's a bridge bank to hold those deposits. The regulators also on Sunday announced 2 different regulatory backstops, which is an unusual aspect of this failure. So the first backstop is called the systemic risk exception. Under that exception, the federal regulators determined that they would insure all deposits, not just the amount that's typically insured by the FDIC in the event of a bank failure, that $250,000 that's typically insured. The systemic risk exception, or the SRE, means that the government was going to back up all deposits, and that was meant to help quell some of the panic, help reassure depositors that they weren't going to be losing hundreds of millions of dollars in this case. A lot of people started calling that a bailout, and it was not a bailout. Those funds come from the FDIC's Deposit Insurance Fund, which is a fund made up of fees assessed on banks for this exact case. In the event of a bank failure, the FDIC pays out deposit insurance from those funds. The other regulatory backstop that was announced on Sunday was the creation of a new Federal Reserve lending facility called the Bank Term Funding Program. And that facility was created to sort of provide additional liquidity to banks who would need it to help prevent deposit runs. And I'll discuss that in more detail later and why it's designed to work that way. But these regulatory responses were controversial because they are not used in most cases. The regulators sent a signal that they were willing to use extraordinary measures to prevent a crisis and to back up these 2 banks. And it raises the issue of moral hazard, which is one of those catchphrases you might have heard in the news over the last couple of weeks. But that risk is that it's the idea that banks might take unnecessary risks because the risks of their behavior have been passed on to someone else, in this case, the Deposit Insurance Fund. So just want to point out that, typically, this event or this failure happened essentially between Wednesday and Friday, about 48 hours. Typically, when a bank fails, it takes significantly longer than that to go from a healthy institution to a failed institution. Typically, it takes weeks, months, even years in some cases between the time there's an indicator that something might be wrong with the bank and the regulatory process takes effect, and the bank is often subject to enforcement actions by the regulators. I can't recall a situation where it's happened so quickly as it did in this case.
I don't think it ever had. And the other weird thing about this is in the middle of the day, you just don't see that. And I'll explain how that usually happens, but
yeah. So to finish up our timeline, the second week of events, Monday, March 13th, again, more panic, bank stocks fall. And that level of panic that we saw on Monday and just kind of how the news was fully consumed by these bank failures and the regulatory response was really unusual. Typically, when a bank fails, it doesn't make the news. It doesn't make headlines. It doesn't affect the markets because things are just kind of wrapped up without it becoming a major issue for people outside the banking industry. So it was really unusual, the level to which this was covered. There was a lot of talk of contagion. At that point, SVB had failed, Signature had failed. Again, Silvergate did not fail, but announced a voluntary liquidation. And there was a lot of talk as to whether or not the bank failures would continue to spread, whether we would see additional banks fail. And along those lines, we started to see assurances from other banks, banks issuing statements, talking to their customers and saying, listen, we are very different from these 2 failed banks, and here's how we're different. Here's why you shouldn't panic. But essentially, these banks had really concentrated customer bases, and there were a number of reasons that those banks were different from the typical community bank, regional bank, and even the larger banks. Monday also, HSBC announced that it would purchase SVB's UK subsidiary. So that's outside the US banking system, but that did make news on Monday. Wanted to mention that. On Tuesday, things recovered a little bit. The panic calmed a little bit. Wednesday, Credit Suisse was in the news. Its shares dropped about 24%, and Credit Suisse has had its share of controversy and problems over the last several years. On Wednesday, the Swiss National Bank announced that it would provide financial support to Credit Suisse if that became necessary. As it turned out, it was not necessary because UBS over the weekend agreed to purchase Credit Suisse for about the equivalent of $3 billion. And I believe they agreed to absorb up to $5 billion in losses. And then on Thursday, March 16th, First Republic Bank, another bank that had been in the news, received $30 billion in deposits from the 11 largest US banks. Those are banks like JP Morgan, Wells, Morgan Stanley, and their peer institutions. At the time those deposits were made, the banks issued a statement saying that they were showing their confidence in the US banking system. As it turns out, it involved a nudge from the regulators, and those banks, in connection with their regulators, thought it would be a good idea to help prop up First Republic Bank. But that's a highly unusual step. Again, can't remember when something like that has happened in recent history. In addition, that bank term funding program, the Federal Reserve lending facility I mentioned earlier, it was announced that US banks borrowed close to $12 billion from that program. And banks are not individually identified, but we do know that banks were seeking that extra source of liquidity as of that week. So with that, I will hand it over to Paul for a minute to discuss the business of banking and kind of give you an overview of what's happening there.
Thanks, Amanda. So I'm just gonna really briefly mention how banking usually works, and with apologies to the bankers that are on. Banking is a relatively simple business, although certainly not an easy business. So for most banks, the income statement consists of their net interest income, which is the difference on how much interest they receive on loans and investments versus what they pay out on deposits. Then the other factors that impact their income statement is the provision for loan losses, non-interest income, and then non-interest expense. But basically, so those are the major components. Probably more interesting, perhaps, is the balance sheet of a bank, and you have to think a little bit backwards from what most of us think about, because in the case of a bank, a loan is an asset and a deposit is a liability. And the balance sheet, the key items there are loans and investments on the left-hand side, and deposits, borrowings, and equity on the right-hand side. And capital is very important to a bank from a regulatory point of view. When a bank fails, it's usually the result of bad loans. I'm going to say 99% of the time that they have bad loans, and as a result, they have to take a charge against earnings, which is through a loan loss provision. Then they have carrying costs from the assets that are bad assets. And one that you might not think about is those assets that are not earning does impact the bank's earning capacity, because banking is a fairly low margin business. So if you have, let's say, 2% of your assets that are not earning, that has a major impact on your earning capacity. And I remember times when I was a younger lawyer working in New England with failed banks. Some of those banks had as much as like 10% of their assets that weren't earning. So the key, and then one of the key elements of banking is the confidence in the banking system and the individual banks. Amanda mentioned that inexplicably, the SVP, the Silicon Valley Bank CEO, even mentioned the word "run" in talking about how they were doing. He said basically, as long as we don't have a bank run, we're okay. So that just is kind of inexplicable. So really a deposit run could happen to anybody, but for right now, that there's no reason to have a bank run, and particularly now, Amanda, with the new lending facility to banks from the Fed, they have a backup. So we can go to the next one. So what happened with Silicon Valley? So it's very unusual. What happened here, it's kind of the perfect storm. The bank made what you would consider to be very conservative investments in government bonds, which obviously have virtually no credit risk. The problem is they had a high percentage of their assets, remember, on the left-hand side of their balance sheet, in these government bonds, but they went quote long. So they had long maturities, and they did this at a time when market interest rates were very low. So what's happened since then, though, is there's been a rapid and large increase in market interest rates. I don't have to tell anybody on this session that happened. So the problem is, if under accounting rules, if those bonds are held in the so-called available for sale portfolio, they have to be marked to market. So they get written down, and the corresponding charge on the other side of the income statement is a hit to equity. So then you've got a situation where all of a sudden, even though those assets, those investments are totally safe, because they're not liquid, they're marked to what they would be able to be sold at, and that in turn reduces equity. So that was an issue. The other thing about Silicon Valley Bank was they did have a high percentage of uninsured deposits. I actually saw as high as 96%, but it's high in any event. I mean, a normal bank might have 30%, and then they tried to raise capital, and they were unable to raise capital. And of course, that further hurt the confidence of the market. And then the other element that was unusual about Silicon Valley Bank is most of the time regulators and bank analysts worry about concentrations in the loan portfolio. Are you too heavily concentrated in the commercial real estate area or something like that? In this case, Silicon Valley had a high concentration of deposits, and nobody really thinks about that very much because we really didn't have to before. And they had a high concentration in the high tech industry, which was having its own problems. So there was a couple of things happened there. Is first of all, they were making fewer deposits, but also they talked to each other and felt that they needed to get out. And of course, with social media and the type of how quickly information can go, that's what ended up happening. There are a number of banks that certainly have embedded losses in their investment portfolio, but for the most part, again, it doesn't really matter. I mean, it matters because it impacts their balance sheet, perhaps, but it isn't like they have a credit risk with those investments. So that's what you typically see. So that's why Silicon Valley was a very unusual circumstance. And I'm going to turn it back over to Amanda, talking about some of the mechanics of a bank failure.
Sure. Thanks, Paul. So I'll start with some practical considerations involved in a bank failure. If you happen to see 60 Minutes over the weekend, they actually played a video from back in 2008, 2009, when bank failures were much more commonplace. And what that video shows is that when a bank fails, it is physically shut down. Typically, it happens at the close of business after customers have left for the day. Typically, it happens on a Friday. And the bank is physically shut down. The doors are locked. Sometimes the blinds are closed. Employees are pulled into a meeting where they are told that they are no longer employed by that bank. And the FDIC brings in teams of specialists, 50, 80, 100 or more specialists in all different areas of bank operations to actually run the bank. It is a really surreal experience being part of a bank failure. And there's a lot of shock and emotion involved, particularly from employees, because they don't usually know ahead of time that their bank is in trouble and is about to fail. And so there's often anger and crying when a bank failure happens. As Paul mentioned, he and Kim and I all have experience advising failed banks, as well as banks that are buying failed banks. And as a lawyer, advising a failed bank is a really bizarre position to be in, because your client is gone. The moment it's seized by the regulators, you are no longer representing that client. And in fact, the client does not exist. And the FDIC actually now holds the attorney-client privilege, which is just a really unusual situation to be in. On the legal side, legal considerations involved in a bank failure. So you may have seen that SVB was closed by the California regulator, the California Department of Financial Protection and Innovation, I think it's called. And the FDIC was appointed as receiver. So just a quick primer on our banking system for those of you who might not be familiar. We have a dual banking system in the US, which means we have state regulation and we have federal regulation. The different chartering authorities on the state level are the different departments of banking in each individual state. So in Pennsylvania, that's the Department of Banking and Securities. So state agencies charter a state chartered bank. On the federal side, the chartering authority for a national bank is an agency called the Office of the Comptroller of the Currency, or the OCC, and they have the authority to issue as well as pull a national bank charter. So banks are chartered under either federal or state law. There are two other regulators on the federal side I want to mention. One is the Federal Reserve Board of Governors, and they supervise and regulate bank holding companies, the parent companies of banks, as well as state chartered banks that are members of the Federal Reserve banking system. There is also the FDIC, or the Federal Deposit Insurance Corporation, which supervises and regulates those state chartered banks that are not members of the Federal Reserve. So there is a lot of interplay and overlap between state and federal regulation in the US. So only the chartering agency has the authority to actually close the bank under federal law. So in the case of SVB, that was the California regulator. In the case of Signature Bank, that was the New York regulator. Both were state chartered banks. The FDIC, as I mentioned, it is a supervisor and regulator of certain types of state banks. But it has a couple of other capacities. It serves as deposit insurer for all FDIC insured institutions, no matter who they are supervised and regulated by. And it also has the capacity to stand as receiver. So as receiver, that's a position similar to a bankruptcy trustee. The receiver stands in the shoes of the failed bank, and its goal is to wind up the bank's assets and dispose of the bank's assets. Resolving the bank is what we call it. So some special considerations in the SVB failure. The deposit insurance, Paul and I have touched on that already. That was a major issue in the SVB failure. What are insured versus uninsured deposits? The FDIC insures deposits up to $250,000 per depositor per ownership category. What that means is that some depositors end up with more than $250,000 of insured deposits, depending on the capacity in which they own their accounts. But when a bank fails, the insurance on those insured deposits is paid out of that deposit insurance fund. That's the FDIC fund that is made up of fees that are assessed on banks. Uninsured depositors sometimes recover money in the event of a bank failure. Sometimes they recover a portion of their money. Sometimes they recover all of it. Sometimes they recover nothing. So you can see why in the case of SVB, where there were $150 billion plus in uninsured deposits, people panicked when they thought the bank might be going under. I think the streaming service or the streaming company Roku announced that they had 487 million in deposits that were primarily uninsured at SVB. And so of course, if you get wind that your bank might be going under, you're going to rush to pull those deposits that are uninsured, because otherwise you risk losing that money entirely. So a couple of other special considerations, the regulatory response to the failure. So I mentioned the systemic risk exception, or the SRE. What is that? Under a federal law called FDICIA, the FDIC has a statutory mandate to resolve banks, that is, wind them up, at the lowest possible cost to the deposit insurance fund. Usually this means that those depositors with uninsured deposits lose some of their money, and that is used to offset the cost to the government from the failure. The systemic risk exception is the sole exception Congress authorized to this lowest cost rule. And under the exception, it can be used if complying with the lowest cost rule poses a risk of serious adverse effect on the economy or on financial stability. When used, the FDIC can guarantee all deposits, not just those insured deposits, which obviously costs a lot more to the FDIC, but this is used in a special circumstance like SVB. By guaranteeing all deposits and not just those insured deposits, the goal is to prevent depositors at other banks from panicking. They make the depositors at the failed bank whole, and it's a signal to the markets and to depositors at other banks that the government is willing to take extraordinary measures to back up all deposits. Because of the magnitude of what that means and the cost associated with it, the SRE has to be approved by the boards of the FDIC and the Federal Reserve. And the Secretary of the Treasury, in consultation with the President, has to agree with the recommendation of those boards. So it is not something that's done lightly. It was enacted as part of FDICA in 1991, and it was not actually used until late 2008 and early 2009. And it was used to resolve 3 of the 4 largest bank failures that happened during that time. I think it was Citibank, Wachovia, and Bank of America. So again, not used for many years until the last couple of weeks. At the same time, the Fed announced the creation of that bank term funding program, which offers term loans of up to 1 year for banks that pledge high quality assets, such as US Treasury bonds, agency debt, and certain other assets as collateral. The pledged collateral will be valued at par, and the margin will be 100% of par value. What that means is that where SVB was forced to sell Treasury bonds at a loss to have the liquidity to pay its depositors, other banks will hopefully not be in that same situation because they can take those bonds and pledge them as collateral and get cash from the Federal Reserve instead of having to actually sell those bonds at a loss. And the goal is to prevent bank runs. It's to stop the bleeding.
It's interesting, Amanda, on that. The Fed has come out with some statements on this, and they said, hey, there's no stigma to participate in the program. They've even encouraged banks to participate as part of their prudent planning for liquidity, liquidity management. And and the other interesting thing about this, which I think is actually pretty smart, they're not going to publicly identify the individual banks that are participating. They're going to talk about how much has been advanced right under the program, but not by banks. So I thought that was an interesting feature.
Yeah, absolutely. And you just moved us along to the next slide. So thank you, Paul. Again, the goal of the program is to help ease liquidity pressure, and a couple of aspects about the program that we just wanted to note. In terms of the collateral that can be used as pledge, it's any collateral eligible for purchase by the Fed banks in open market operations. So some of those items I mentioned on the last slide. Banks can borrow up to the value of the eligible collateral that they pledge. There's no limit to the size or number of advances that banks can get. And this is available to all US banks as well as US branches of foreign banks. And as Paul mentioned, it's something that they're encouraging banks to use. Sometimes, a new program like this will come out and banks are hesitant to actually use it. But in this case, as I mentioned, they've borrowed $11.9 billion from the program in the last week since it was created. So effects of a bank failure on customers. Paul, do you want to talk about that?
Sure. One thing that just hit me, Amanda, before I get into that, there's a little bit of an irony here, and it just hit me now that some of the collateral are government bonds, right? And some of those bonds are the things that caused the problem with Silicon Valley Bank, and it shows the credit of that collateral is fine. It was just the interest rates that were being paid on them, right? So
yeah.
Kind of fascinating if you think about it. So the impact on customers, typically in a failed bank situation, it doesn't have a ton of impact. The borrowers still pay their loans to the new bank that took them over. Most of quite often, and I'll mention this later too, that the deposits are assumed, so it's not a big deal. You can see though, in this case, as we mentioned, the uninsured deposits, you can see why there was some panic among them. The payroll situation, say you're the CFO of a tech company, you've transferred your payroll funds on a Wednesday, right? And to the bank to pay through the payroll that you got set up. And then the bank all of a sudden fails. It's a fascinating legal problem, which hopefully we'll never run into, is whether it doesn't seem fair, because a lot of times, obviously, officers of a company have personal liability if they don't pay payroll. But it does seem a little bit, it would have been an unfair result had the money actually been transferred and it ended up to be the bank had a problem, or the payroll provider, company was using a bank that failed. So that's kind of an interesting one. The other thing that was, I think, one of the reasons that people were concerned about this, there haven't been a lot of IPOs recently, but some tech companies had almost all of their proceeds from their IPOs in Silicon Valley Bank. So you hate to go raise money, right, in equity, and all of a sudden that money disappears in it with a bank failure. The little bit of an interesting personal part of this story is I have my son-in-law works up in New England remotely for a Silicon Valley startup. And as you can imagine, I had a fair amount of text messages back and forth with him about what that meant to his company. Amanda, his company was one of those that had already gotten their money out, as it turned out. But of course, he wouldn't have known that as somebody that worked for the company. But it does show you the impact it can have. It can have on in terms of the far-reaching nature of it.
Yeah.
So switching to the the next slide is kind of talks about most of the time. Amanda kind of alluded to this before. If the regulators know that there's a bank that's in trouble, they will go out confidentially, and it's amazing. I've never seen a leak on this. They'll go out to potential companies that might have an interest in buying the franchise in a confidential bid process, and banks will make a bid, and then if in fact the bank is taken over, it's usually done at the end of close of business on a Friday, and by Monday morning, everything is up and running under the new bank, under the buyers. So that's generally what happens in most banks. And Amanda, we've worked with banks like this. They've been subject to regulatory orders, either memorandums of understanding or cease and desist orders or whatever, for months and maybe even years. So it's not incredibly surprising that a bank, has a problem that ends up being a failure. I lived through that again when I was a young lawyer in New England. I was actually physically present at a client when the regulators came in on a Friday night. And Amanda, you're right, there was anger and tears and everything else. So that's it's so different here because SVB actually was I think their capital position made them more than adequately capitalized. So it just happened so fast. There was no time to set up a bidding procedure, and that's why they kind of stumbled a little bit, closed it at noon, and still didn't have a buyer, and still doesn't have a buyer, although there's a rumor that they're out looking at selling the franchise for sure. If you're a buyer of a failed bank, generally you agree to assume the deposits and to fill the balance sheet. You get some assets, but typically, remember, the bank failed because it had a lot of bad loans. So you don't get the bad loans, and the FDIC fills that hole on the balance sheet on the left side with cash, which sounds pretty risk-free. On the other hand, it's hard to put cash back out to work during a downturn, which is usually when bad loans happen. So there's a little bit of a risk in terms of return on assets that goes down because you get all this cash, which seems kind of counterintuitive, but that is how it works. On the next one, so what do the customers do? It's a pretty difficult situation for a normal person to look at a bank's balance sheet and income statement and everything else and figure out if they're okay. I will say in our market, I can't think of anybody that even comes close to being in a situation like this. The question we're going to have now, I know Amanda, you and I have listened to a lot of different presentations and read a lot of information about the last 10 days. Will depositors seek to diversify their banks if they have deposits above the insured limit? I think for the most part, that's really not necessary. I think we may run into some situations where it's a public entity and the person in charge feels a fiduciary duty or whatever to spread the money around, but I don't really think that's going to be necessary. But I understand the concern, and I think that's why people are communicating with their customers. We have seen some on a macro basis, but I don't think this is regionally. Amanda, there's some intelligence that say some deposits have moved to larger banks, maybe, so that people feel a little bit safer there, but I don't know that that's going to be a major impact.
Yeah.
So on the next slide, Amanda and I are going to do the next couple of topics together. Because everybody, of course, when anything goes wrong, what's the human nature, right? It's somebody's fault. Did the regulators drop the ball here? I think it really is too early to know. Certainly the regulators were aware of this, and there's been of the situation, but nobody expected such a rapid decline. I want to, Amanda, the quote in the middle of the page here, where the a member of the vice chair of the supervision division of the Fed said, "We need to have humility and conduct a careful and thorough review of how we supervise and regulated this firm and what we should learn from this experience." That's a pretty modest statement from a regulator, because they don't tend to lack confidence most of the time, and it just shows that they like all the rest of us didn't know what to make of this. And but I don't know, Amanda, it's just hard to know. If I guess we'll find out. I'm sure they'll do a study, right?
Yes, and they are doing a study.
And I guess now that I look at it, I think it's May 1st is when they're going to release it. I'd be surprised if they're going to know by then, but but there certainly have been some press out there since then, that they were fully aware of the imbalance, both in terms of maturities and liquidity issues. So, but again,
I think it's important to know, Paul. I think, chances are the regulators missed something. They should have caught something that they didn't catch in these cases. But it's also important for maybe those who don't work at banks to understand that banks do have discretion as to how to conduct their business and how to manage their balance sheets. And so it's kind of a fine line that the regulators walk between making sure that banks meet certain baseline standards, but not overreaching and requiring too much of the banks that they're supervising and regulating. So, maybe it's going to fall kind of in that gray area where they could have caught something, but it was also kind of up to the bank how to run its business.
So on the next slide, we talk about some other differentiating factors. This bank really did grow very quickly, and that usually does get the regulators' attention when you have a bank that grows quickly. But quite frankly, that's usually the issue, is they worry about their loan portfolio, right? Because they're thinking that they might be stretching for loans as they grow. That really wasn't an issue here. Obviously, we know about the uninsured deposits. They were funding a lot of their liquidity needs from the Federal Home Loan Bank in San Francisco. So that kind of points at some liquidity risk. Mm-hmm. And obviously, we've already pointed out, Amanda, the susceptibility to interest rate increases, right, because of the bond portfolio.
Yeah.
Do you want to mention the thing that's getting the political attention on the change in Dodd-Frank? Yeah, if you don't mind.
Yeah. So in 2018, some of the Dodd-Frank provisions regarding stress testing, so-called stress testing, were rolled back for banks that are in the same category of size as SVB. And so it exempted some banks with assets of up to $250 billion from certain supervisory measures, including stress tests, as well as certain capital and liquidity requirements. This is something that has been politicized and can't really weigh in either way on who's right and who's wrong here. But, it's not, on one hand, Dodd-Frank put some really stringent requirements in place that were geared to prevent this sort of thing from happening. On the other hand, banks spend a lot of money on compliance and trying to comply with new rules and new regulations as they're put out. And so there was a legitimate question as to whether or not, banks of this size really need to be subject to stress testing, which is a pretty onerous process. It's expensive. It takes a lot of time and resources from the bank. And so that's something that you may have heard a little bit about in the news. Also, apparently, SVB had not had a chief risk officer for the better part of a year. And so that's something that's interesting and a little bit unusual here. Paul, anything else here, or on to the next one?
Yeah, I think the other thing that's got a little bit of political attention, right, is the use of this systematic risk exception, right? Yeah. Because some people, it's kind of discouraging to see the politicization of this. But some people are saying, hey, they're just bailing out the tech companies, and Amanda and I, being bank regulatory lawyers, were like, yeah, I think they're really just trying to protect the system. But I guess you could make an argument, I suppose. But
that's right. And again, it's not a bailout. It's
Yeah,
funds assessed by banks or assessed from banks. So call it what you will, it's not a bailout.
yep. So on the next one, Amanda, I think you and I have seen some nice pieces by banks, written pieces, to reassure their customers. I think the basic theme of this is to differentiate themselves from this set of circumstances, which is, we've both mentioned this is a highly unique set of circumstances. I think the other thing you need to do, and we'll talk about this a little bit, but this happens to be the same week we're having our annual Lendicon conference. We're going to have a panel of bankers that are going to share with us some of their thoughts on how to handle this. I think the other thing is to make sure your people that have customer contact know what the talking points should be, right? Because I don't know how many people read just the written reassurance letter from the CEO of the bank or whatever. And those are important, don't get me wrong, but I think hand-holding may be just as important. I don't know, Amanda, what are you seeing out there?
Yeah, I think we've seen some really good communications from banks. Along those lines, we are very different from SVB and Signature Bank. This is how we are different. We are well capitalized, and a lot of good talking points from banks that we've seen, and we've talked about that a little bit. I also think, it's really important to stress how and why the average or typical regional bank or community bank is different from these institutions. And so Silicon Valley Bank had a highly concentrated depositor base. And so when these venture capital firms started advising their clients or advising their portfolio companies to pull out of SVB, that really didn't take a whole lot. If you have 10 different companies with 500 million in deposits each, that deposit run starts to happen pretty quickly. And for the typical bank, you just don't have that concentration. You don't have that same customer base. And I think, that's something that's really important to stress to customers. I think the other thing that's important is for the majority of customers, all of their funds are insured by the FDIC, and no one has ever lost a penny of FDIC insured funds since the FDIC was created in the wake of the Great Depression in 1933. And I think that's relevant to your average consumer who is concerned. You see people showing up at failed banks with suitcases, and that's just not necessary for most people because most of those deposits are insured.
So Amanda, what you're saying is the majority of us don't need to sit there and scrutinize the balance sheet of the bank that we're with, right?
That's right.
So what do we think we're going to see in the future? Amanda, I'm going to let you take a couple of these, and now we'll make a couple thoughts as well.
Sure. So the big one, the one we've been asked since this started over a week ago, will there be more bank failures? Will these events create contagion? I think there's a risk of that, but I think the risk is extremely limited. I think for all the reasons we talked about, the banks that have failed have been in really unusual positions. They are not your average community bank or regional bank. And so do I think we'll see it spread? I think there's a chance another bank, maybe a couple more banks fail over the course of the coming weeks. But I don't think it's something that we need to worry about. It is not a cause for panic. It's not going to be systemic based on what we know right now, right? Things change rapidly. Maybe we get more information and that changes, but is there a risk of contagion? Of course. Is it a high likelihood? No, I don't think so. And I think, Paul, you agree with that.
I agree. Yeah.
What will the effects be on FDIC insurance? Mention that the FDIC provides insurance of up to $250,000 per depositor per ownership category. And I've seen some talk in recent days as to whether or not that's high enough. I think, that's something that might be on the table considering increasing deposit insurance. How much does that matter for depositors like those Silicon Valley Bank had? Not a whole lot. I mean, even if they double deposit insurance to $500,000, that's still a drop in the bucket for a company like Roku with 500 million in deposits at a bank. So I think there's a chance we'll see increased insurance, but we'll see. Rush to move deposits to larger banks. We've seen a little bit of that already, but I think we'll have to just kind of wait and see what depositors decide to do. Will SVB change the way that regulators approach troubled banks? Possibly, but I don't know if you have any thoughts on that one or any of the others. Paul, I'll turn it over to you.
That's the one it's interesting to me is, usually the regulators move at a fairly measured pace with a bank
Mhm.
that's in trouble, because they really haven't had a problem where the money it gets out. And even if somebody was aware that a bank had some issues, they were pretty assured that they were gonna be okay, because
Yeah,
the FDIC would resolve it in a way that would work.
yeah,
Here, it'll be interesting to see if the regulators feel a need to move quicker, because information moves so much faster, even compared to 08, 09, right?
yeah.
We have a pretty big difference. The other interesting question that was raised to me by a bank director this week is, will the Fed be more cautious on raising interest rates? Because obviously the Fed is doing that to try to fight inflation. But the problem with it in the banking sector is, if they keep doing that, I mentioned the bond portfolio, that will cause further problems in terms of impairment of the value of the bond portfolio, and they don't want to trigger something unintended. So they're going to be in a tough position in my mind. And then the other thing, Amanda, and you may want to comment on this, I have no doubt that that the regulators are going to look a lot harder at liquidity and interest rate risk, as they're talking to banks. And I suspect that some of the bankers that are on this session probably are already getting some communications and are looking at that internally. But I think I think the liquidity in particular, right, because of the quickness and how fast this went.
Yeah, absolutely. When there are situations like this, and we saw this in the wake of the Great Recession, we go back and fix the things that went wrong with the last crisis or the last round of bank failures. And so I think that's absolutely right, that we're gonna see the regulators go back and kind of dissect, do a postmortem on SVB and Signature, and see what went wrong and what needs to change, if anything, moving forward. And I think we should expect to see that.
So, Amanda, what do you think about which banks are going to be considered to be systematically important? That's a tough one, I would think. But
Yeah, we've already had a round of discussions about that designation in the wake of the Great Recession. And so I think, looking at those really big ones, I'm not sure the criteria for being systemically important is really going to change. But it's certainly something we're going to hear a lot of discussion about.
and those really large banks, Amanda, and you may want to explain this, they actually have living wills, right? They're required to put
Yeah.
those together. You want
Yeah.
to talk about that as a weird concept?
Yeah. Yeah, so living will is like the colloquial term for it, but banks of a certain size are required to create and maintain a resolution plan, that in the event things go bad for the bank, how the bank will resolve itself. And that was something that was enacted as part of the Dodd-Frank Act in the wake of the recession. And that is something that banks of a certain size are required to do. And the idea is to help with the orderly wind down of those banks in the event of failure.
And they are also required to do stress testing more, right? That's the other thing.
Yeah,
So,
and that is kind of measuring how different factors affect the bank's balance sheet.
so the final one that kind of catches my eye, that's actually on this page, and I can't imagine this is going to happen, but we put in there, I think the second bullet at the end there, will FASB change the rules on marking to market securities? I think that's somewhat unlikely, but it does show you what a kind of a crazy result we ended up with here, where very creditworthy investments ended up triggering a big decrease in capital, and then things went from there because of the movement of interest rates, market interest rates. So
Yeah.
I understand why that county rule is the way it is, because they're not as valuable, right? Those securities as they were when the banks bought them. But if they can hold them to maturity, of course, then it's not an issue. But
Mhm.
if you mark them to market, it becomes an issue. So
That's right. Yeah, and that's why that Fed lending facility is so important, because you get the cash value of those securities without having to actually sell them at a loss. And I think that program lasts for the next year. I think banks can take loans out until March 2024 under that program. So we'll see if that kind of stems the tide of things that have been going on recently. So do you want to move to some audience questions if we have them? I think.
sure, we had a few. Kevin, you had asked about what the impact on tech lending would be. Kevin St. Cyr. And my answer was in the chat was that, you know, I really think it's possible that the regulators will sell this franchise to somebody else that has an interest in that niche. But I think it will have some dampening effect on borrowing by that. You know, they were kind of the go-to, you know, bank. One of my good friends, his daughter actually lives up in Boston and worked for Silicon Valley Bank. And I noticed the change in her LinkedIn, Amanda, in terms of who she works for now. So she's working for the Bridge Bank or whatever. But so I don't know. I mean, I've heard rumors that they're out there trying to sell the franchise, but I don't know if you have any thoughts there.
Yeah, again, I've heard rumors there, and I actually can't see the chat questions.
Okay.
I'm not sure why, but if you want to go through and read some of the others, or if maybe one of the marketing folks wants to chime in and do something.
I think the only other question that we probably haven't really, I think we've addressed it to some degree.
Okay.
You know, they wanted to know if we thought the regulators dropped the ball when it comes to concentration risk, took too much in tech industry and startups. My thought there, which again, generally that would have been the concern, would have been in the loan portfolio, right? I'm not sure any of us, you know, really focused on the risk that a deposit concentration by industry would have. I don't know what your thoughts there are. I'm just not sure that I ever heard about that before, Amanda.
Yeah, I agree with that. I mean, I don't know that I would say the regulators missed something there. I mean, obviously hindsight is 2020, and we can now see that that was a problem for these banks in a way that it's not for other banks. And so, of course, that's something we're going to look at moving forward. But should they have looked at that and seen something? You know, I don't think so. I don't think that by virtue of the fact that the depositors are concentrated in a certain industry, I don't think that should have raised any flags that the regulators missed in this case. Now, moving forward, sure, it's something that needs to be looked at. But what are your thoughts on that?
Yeah, so I think it's interesting because if you look at banks 10Ks, right, there is a table that shows concentration in the lending portfolio by industry. You know, I'll be curious to see if the rules will be amended to say, show us the concentration of your deposit portfolio by industry. And I don't know if that's really necessary in most cases because, you know, like we said, a great percentage of the majority of most banks deposits are already insured. So I'm not really sure. Maybe they would require you to show, this would be, I don't know how much work this would be though, to put together, you know, the percentage by industry of your uninsured deposits. I could see the regulators doing something like that, the SEC, you know, having a disclosure. But again, I'm not sure that really helps a lot other than just, you know, it might put a spotlight on some potential issues. But I think, again, it's so unusual that we're going to see a run here, especially with the new Fed facility.
Yeah.
So here you go. Here's one. I'll let the younger panelists talk about this. It says, any thought on crypto's impact? I guess that would be more with Silvergate, Amanda. Would that have been?
Yeah, Silvergate was pretty heavy in crypto. Any thoughts on what that means for the industry? I mean, I think crypto is seen as a relatively risky industry. And I think, you know, to the extent that much of the industry is unregulated, things like the bankruptcy of FTX maybe pose a bigger risk in the crypto industry than in other industries. So FTX was a crypto exchange that went bankrupt a few months ago, and that played a role in Silvergate Bank ultimately announcing its liquidation. So, you know, it's kind of easy to blame the new guy for the problems, you know, but crypto is largely unregulated. It is riskier than pretty much any other bank product. And so I think, you know, it did play a role, and I think it's certainly something that's going to be looked at. I
think the question might have also focused a little bit on, I do think the regulators will really look hard at a bank that specializes in crypto though, right?
Oh,
I think that's, you know.
Yeah, absolutely. Yeah.
So I think that would be an issue.
I agree.
I think that's all we have for right now. And on the category, it's better to be lucky than good, we actually hit right on our hour. And I guess I'd like to thank everybody for participating. We're going to talk about some of these issues on Thursday at the Lendicon. We changed the last panel there, which was originally going to talk about some other issues, to get some bankers on the panel and talk a little bit about how they're approaching this situation. And I want to, in addition to thanking everybody, I want to thank Amanda, who really brought a lot of expertise to this. And Amanda, you are you said you're getting sick of seeing your face on LinkedIn, because she's already presented in another session, and I think you're going to be next week on a session in the Lancaster chamber, right, with some other bankers. So
that's right, and we'll be at Lendicon on Thursday. So, yes, thank you, Paul. Appreciate your expertise. It's hard to take the place of several decades of experience in the industry. So appreciate the input.
Some of those were painful, but thanks for everybody. And I think we're all set for the marketing folks to say goodbye. Thank you.
Thank you all for joining us.